The casino world thrives on risk, but tonight, the stakes have changed. MGM Resorts International, a Las Vegas icon, has abruptly withdrawn its bid for a New York City casino license. This isn't just a business move, it's a warning sign from one of the industry's giants. For decades, casino operators chased new markets with relentless ambition. New York was the ultimate prize. MGM's retreat signals that the risks now outweigh the rewards, even for the biggest players. Investors and competitors are rattled. The narrative has shifted from endless growth to cautious survival. This is the first major crack in a facade that has stood for generations. The industry is grappling with new economic realities, fierce competition, and changing consumer habits. The game has changed, and not everyone can afford to stay at the table. MGM's move is a pivotal moment, a realignment for an industry built on spectacle. The collapse of the New York bid is a symptom of deeper problems in the casino business model. The house of cards is trembling. The big question, who's next to fold? To understand MGM's retreat, look at its financials. The company is buried under $32 billion in debt, over 3 times its market value. That debt is an anchor, making bold investments nearly impossible. MGM's net margin is a weak 4.3%, far below the S&P 500 average. Even a small dip in revenue or rise in costs could wipe out profits. The company's stock has been battered by every major economic shock in recent memory. In 2008, MGM's stock lost 98% of its value. The pandemic and inflation hit hard, too. This is a business model exposed to every downturn. MGM's executives saw the writing on the wall. More debt for a risky New York project was a gamble they couldn't afford. Financial analysts now rate MGM's health as weak. The company projects strength, but its foundation is fragile. Pulling out of New York wasn't weakness, it was survival. The New York casino license was the industry's Super Bowl, a rare shot at a massive market, but fierce competition and market saturation made the prize less appealing. MGM cited short license terms and the risk of investing billions with no guarantee of long-term returns. For a company already struggling with debt, it was an unacceptable risk. With MGM out, the field narrows, but the pressure on remaining bidders intensifies. The high cost, political hurdles, and regulatory uncertainty make this a treacherous game. MGM's exit is a cautionary tale. Chasing growth at any cost can backfire. The era of building mega casinos and expecting instant success is ending. The New York gamble proved too costly, even for a giant. With MGM retreating, attention turns to Wynn Resorts and its $10.5 billion bet on new projects. Wynn is doubling down on the luxury casino model, even as market conditions worsen. The same risks that spooked MGM, competition, economic fragility, now threaten Wynn's massive investment. If Wynn's gamble pays off, it'll be called visionary. If not, the fallout could be devastating. The cost of building mega resorts is soaring, while returns are no longer guaranteed. Online gaming is rising and high rollers are tightening their belts. Wynn is betting billions that these trends will reverse, a risky move. MGM's collapse was the warning. Wynn's bet could be the next test. The industry's future may hinge on whether Wynn's wager's genius or folly. The high-stakes drama is unfolding in real time. MGM's digital arm, BetMGM, is thriving, projecting $2.6 billion in revenue and its first $100 million in earnings. But this digital success is a mirage, masking the parent company's deep problems. The legacy casino business is capital-intensive, expensive, and vulnerable to downturns. BetMGM's growth shows where the industry's energy is, online, not in physical resorts. Yet, $100 million in digital profit is a drop in the ocean compared to MGM's $32 billion debt. The company faces an identity crisis. Is it a tech leader or a struggling real estate giant? The digital boom can't fix the core business's fundamental weaknesses. BetMGM's success is real, but it's not enough to save the empire. BetMGM's rise is powered by the explosion of sports betting. Sports betting is now a multi-billion-dollar industry, deeply woven into the fabric of professional sports. Massive prize pools and high-profile events create endless betting opportunities and fan engagement. Every tournament, every play, becomes a chance to bet, fueling a 24/7 digital gambling cycle. The casino now comes to the customer, not the other way around. Millions of casual fans can place bets from home, unlocking a vast new market. This shift is both an opportunity and a threat for casino giants. Online betting makes billion-dollar resorts seem less essential. the rise of sports betting has fundamentally changed customer expectations. Legacy casinos must adapt, or risk being left behind. MGM's retreat and Wynn's risky bet mark a turning point for the casino industry. The era of endless expansion is over. Debt, market saturation, and digital disruption are rewriting the rules. Casino giants now face a long, grinding battle for survival. Their sprawling resorts are expensive to maintain and no longer guaranteed profit machines. The real competition is now online, where nimble tech companies thrive. The next phase is about efficiency, debt management, and smarter, smaller bets. Some, like MGM, may pivot to digital. Others, like Wynn, double down on luxury. The future belongs to those who adapt to a digital-first world. The golden age of the mega casino is fading. The bright lights remain, but the empires behind them face their greatest challenge yet.